So let's say there's a buyer and they're thinking, might want to take the next step in 2026, but those interest rates, are they going to drop? Is now the time to jump and go get it? What do you foresee there?
Well, as rates are dropping, there isn't a emotional fear of missing out. As rates are going down, they jump in when there's a fear that the rates are going up. You know the old story, when's the best time to plant a tree?
10 years ago?
40 years ago. When's the second best time to plant a tree?
Today.
Yeah. Welcome to Lawrence Real and Local, Keepin' It Real podcast presented to you by the Lawrence Board of REALTORs. We're your go-to source for all things real estate in Lawrence, Kansas. I'm Lexie Haskin with Bank Midwest.
And I'm Patrick Dipman with McGrew Real Estate. Together, we are here to make the journey to homeownership a breeze. Join us as we share insider insights, expert advice, and a dose of fun along the way.
Welcome to Lawrence Real and Local, Keepin' It Real podcast by the Lawrence Board of REALTORs. My name is Lexie Haskin with Bank Midwest.
And I'm Patrick Dipman with McGrew Real Estate.
And we're joined here today with Rob Hulse, the Vice President of the Lawrence Board of REALTORs. He's back.
Do you have sound effects?
We can add a little.
We're going to add something.
That's funny.
There you go.
That's my only applause for the year.
I was like, that kind of went on a little too long. Maybe I should have not that you don't deserve a long applause.
Yeah, well, I know better.
Because you do.
Yeah.
But maybe I need to figure out how to make that better in the future.
Yeah.
We can incorporate more sound effects to this season of the podcast.
Awesome.
So, well, today we are going to be talking about 2026 market predictions.
Yeah.
And we figured, why not start the year off with some of that? So you know what to kind of expect. So do you just want to dive in? Or Rob, do you have any opening remarks?
Well, first of all, thank you for being here, for the opportunity. You guys just do such a great job on this podcast. And so thank you on behalf of the Lawrence Board of REALTORs, right? I mean, so you do a tremendous service for us with regard to community awareness and helping us share news and information to not only members, but really out in the community. So great work, great job, and thank you. And look forward to another great year of this.
Well, also, before we get started, you might recognize Patrick from last year. He did step in for Campbell, and he is now going to be the co-host moving forward. So you're going to be seeing a lot more of him.
Thanks for having me.
He waved for those people at home listening.
Appreciate it.
They don't catch that on Spotify.
We're going to see what I get myself into long term here. Fingers crossed it goes well.
Oh my gosh. I know that after last year when you came on, I was like, okay, if Campbell ever doesn't want to do this, I'm asking Patrick. I was like, he's going to be my first call. And luckily he said yes.
Well, it'll take some time to maybe get used to it and be a little more comfortable. But again, this is a great person to start out with. So.
Oh, wow. What a segue.
I know, what a segue. I know he's a natural.
Oh,
he's just buttering you up right before the episode.
Yeah.
So, but okay, as the Vice President of the Lawrence Board of REALTORs, you have this unique view. You can kind of just see the whole market. You can see what all of the different agencies are doing too. You talk to most of the realtors in the region across Kansas, nationwide. You go to all these conferences. So what indicators are you looking at more closely as we head into 2026?
Well, it's a great question. I'm not an expert, so I look to the experts. So the indicators to me are more like people, right? So it's Lawrence Yun with the National Association of Realtors, our chief economist for NAR, and the insight that he and his team have with regard to the marketplace. And that's nationally, but they also hone in and drill down a little more deeply, really into regional marketplaces. Lawrence specifically isn't one of their targets. We're just not quite to scale, but we could look at Kansas City, for example, and see what they're projecting for Kansas City as well as Wichita and then other metro areas like Omaha, more regional Midwest markets to see what they're doing. So we look to Lawrence Yun. We work closely with the Center for Real Estate at Wichita State University, as well as the Center for Economic Development and Business Resources. I'm starting to get really good at saying that, the CEDBR from Wichita State as well. And some of their indicators include economic indicators, like, what's the job market look like? What's happening in finance with interest rates? what's going on externally outside of the market that will impact the confidence that folks in our community have, whether they're buying and selling.
Yeah.
And so I probably lean in more into people or organizations as those indicators because I'm not an economist and I can't look at trends, and the bond rate and the this, that, and the other and really project that myself. So I'm just a conduit for all of those others and able to share those resources.
Well, you do a great job communicating it with us and the rest of the board and the realtors. So what perfect person to come communicate it on this podcast.
That's it. I'm the conduit.
If you were to take a step back as we wrap up 2025, move into 2026, what might your recap be for somebody on 2025?
So I'm a little bit of a broken record. And, we always talk about the three most important things in real estate. The three most important things are
price.
Well, you used to say location, but it could be price, condition. And for me, and I shared this at a chamber event recently, the three most important elements of our housing market here are inventory. Yeah. We are so impacted by our levels of available inventory, available housing. And it's really, I think, curtailed our market and continues to curtail our market. So as we look back, and I see that throughout all of 2025, we maintained an inventory level of 2 months or under.
And it's not a lot at all.
No. So a balanced market will have 4 to 6 months of supply. In other words, if you sell 10 houses a month and you have 40 houses on the market, you have 4 months supply, right? Well, the numbers are obviously bigger than that, but that's just simple math for you. So we sit at less than a 2-month supply, and generally those vacillate between 1.5 to 2 months. A few years back, we were even under a 1-month supply. So things have improved a little bit, and it's eased a little bit of the tension that we have in the marketplace with regard to available supply, but not nearly enough. And we need new development. We need all options for housing, not just greater density and urban lofts. And we need those, but we also need your more traditional single-family residential. We're seeing some growth in the multifamily market with permits that are pulled for duplexes. So that's nice to see some additional, investment in duplex building. Way back when I was an agent, so long ago, we sold a lot of duplexes. I mean, or townhomes, one side of the duplex. That was a really good, affordable solution for someone entering the market, is that they would buy a single townhome. And then that just really went away in the 2008, 9, 10, 11 timeframe. And now we do see that coming back. And I think that's a really great entry point back into the market for some of our first-time home buyers.
I think, too, with buying duplexes with both sides, that's becoming really popular for people wanting to do house hacking and affordability and continuing to grow their investments. And it really can be a good foothold into building wealth long term.
Absolutely.
So
we sat through a presentation recently. This is how I go, guys. I'm like way off your mark already.
Right. Keep going. No,
so we sat through.
I kind of went off too.
We sat through a presentation in this last month from Strong Towns. If you're familiar with Strong Towns, you can look them up. Just Google Strong Towns. Strong Towns
Google it right now.
Has some belief that there's certain ways communities should be built and should be structured, but one of the facets of Strong Towns that they discuss are incremental development. So developers don't come in just one size. They aren't just the big, I'm going to buy, hundreds of acres and annex it into the city and do big master developments. Development can occur in your own backyard with an ADU, or it could occur by doing exactly what you just described, which is I want to buy a 2-unit property. I'm going to live in one side and rent the other side out, and I'm going to become basically a developer. Then maybe I'm going to go build one of those, right? And then maybe at that point, now I own 4 units, and then maybe I'm going to do something maybe even a little bit bigger than that. And I'll do something to a little bit greater scale. And so I go from 1 unit to 2 to 4, and it's an incremental developer model that is important to communities. And it really is a great way to build wealth.
I mean, people don't even realize that you can use that second home to qualify for that current home as well. You can use the income from the other side to qualify for your home. So, I mean, it's just great. Well,
Getting creative.
Yeah. I was very jumbled saying that and spitting it out. But also, when I say Strong Towns is serious, they are a .org.
Oh, well, okay.
They are a .org, so you know that they are.
There you go.
I'll check it out later.
Not just a .com, they're serious.
Based on kind of our
qualifier,
based on our low inventory, do you see that changing as we move into 2026?
So I read the paper just like you all do too, and saw that Mayor Finkeldei gave his address as he was installed as mayor for the coming year, and he was very optimistic, and he talked about a lot of the new development, and that we've, building permits for commercial are double right now as opposed to what they've been in prior years, and we've got some good commercial development. Costco, holy cow! Costco is coming to town, right? There's some great news on the development side. There's some big developments that potentially are going to get annexed into the city, and so Mayor Finkeldei talked very optimistically about all that is to come in 2026. And I'll tell you, in my estimation, that we need to probably temper our expectations a little bit, because those things take time. And when we do good things like getting infrastructure to the west side of K10, which we had great help from the chamber with in recent years to get the city's infrastructure under K10 as K10 is being developed and improved out to the west. And so we've pushed utilities. I say we. The city of Lawrence has pushed utilities so that it's ripe and primed for annexation and development now. And now we have a developer lined up. But those things take time.
Yeah.
And so so I'm excited too. I'm excited. I'm optimistic. I think it bodes really well for the city of Lawrence. We need to get a little pressure off of Douglas County that has seen such an influx of development in the unincorporated areas of Douglas County, so that we can ease a little bit of that tension in the county by making land and property available for development in Lawrence, and we just don't have that. So this will be a really welcome thing. Yeah. But to answer your question, I'll temper those expectations a little bit and say I'm optimistic, but it's going to take a little bit of time.
Do you think that they are also feeling the pressure to increase development because of what Baldwin City is doing with the 3 new neighborhoods with approximately 120 lots that they're working on building?
Baldwin City is doing an amazing job at identifying ways to bring in some additional funding, subsidize some of those projects. They are at the size of a community where they have some of those opportunities that Lawrence may not, but they're doing a fantastic and an amazing job at growing development, and they should be. And I think Eudora is really investing in the city's infrastructure with being so much closer to DeSoto and the Panasonic and all the growth and development that's coming westward from our metro area to the west. So they're doing great things. I don't know that the city of Lawrence feels pressured in that way competitively. I would like to think that they would because we know that development helps pay taxes, and that increases tax roll, which helps to provide the city services and the things that we know, love, and adore about Lawrence, whether it's parks and recreation space, or whether it's the ability to clear our streets and pick up our trash and deliver valuable services, emergency services, things like that to the county as well as to the city.
And we will have an episode talking more about property taxes a little bit later in the season, but we won't dive into that right now because I know it's also it's a hard spot because people are so mad about them because they're going up.
Going up like crazy. We've always felt like especially residential ownership carries a disproportionate burden of the taxation in our community because we don't have a lot of commercial economic development. We need to grow commercial economic development to take some of the pressure off of our rooftops and ease the taxation burden on our residents in the community, rather than continue to grow that demand and ask more and more and more of our residential rooftops. Taxes are very high.
But with having more commercial building permits and everything like that, that makes it does make it sound more exciting for 2026.
Absolutely. And it circle back to Mayor Finkeldye, it bodes well. It bodes well. There's some things really in the works, and I think we can be optimistic about that.
So let's say that there's a buyer who's sitting out there on the sidelines, and they're thinking, well, I might want to take the next step in 2026. But those interest rates, are they going to drop? Is now the time to jump and go get it? What do you kind of foresee there?
Well, first of all, there's an interesting phenomenon that occurs, and that is, at least that I've observed. Lexie, you can speak to this more so than I, but I've always been told, and I've observed, that as rates are dropping, there isn't a emotional fear of missing out, and people don't jump in as rates are going down. They jump in when there's a fear that the rates are going up.
Yeah.
And that as rates have stabilized now and are really very attractive in the mid 6% range and are likely to remain there, I don't know that the rates themselves are going to be the motivator for buyers, but you know the old story, when's the best time to plant a tree?
Yesterday. Or 10 years ago.
40 years ago. 40 years ago. When's the second best time to plant a tree? Today.
Yeah.
So if you sit on the sidelines and wait and don't jump in as a first-time home buyer, the consistent, steady increase in value that real estate has proven to have over the years is something you're going to miss out on. So you may or may not feel motivated by interest rates to miss out on something, but you sure ought to feel like you're missing out on the potential for wealth building through increase in your assets. So once you buy that property at a certain amount, when you get 5% increase in your valuation per year, it's 5% of the whole thing, right? If you buy at $250,000, it's 5% of $250,000, not 5% of your down payment, right? Not 5% of what you put into the equation. It's 5% of the whole thing, and so there's just not a better way to capitalize on your investment than to do that. If you could buy stocks at a down payment, but get the gain on the whole stock, portfolio as a whole, that'd be great. But you don't. You get what you buy. Well, with real estate, your investment gets you the opportunity to realize wealth on the gain that you have for the entire piece, right? Not just your down payment. Does that make sense? Yeah. So I think we don't think about that enough.
And a lot of people will think about interest rates, but it really isn't the end-all, be-all. There are other things, too, that people have to take into account, like a total monthly payment, because mortgage insurance, especially as a first-time home buyer, if you're putting down less than 20%, can have a really large impact and can vary from lender to lender. And even if somebody has the same interest rate, APR, closing, whatever, if they have a different mortgage insurance, it can be higher one place versus the other for that total monthly payment. So that is very important to take a look at as well. But yeah, even just looking at the interest rate forecast from Fannie and Freddie, they're saying that at the end of 2026, it's going to be between 6 and 6.5. So it's kind of around where we're at right now at the end of 2025. So it isn't going to be varying too much, just kind of going up and down. But like Rob said, if people are more likely to jump in if they think it's going to go up, because otherwise they're just going to keep waiting to see if it's going to come back down. And even talking about people that were refinancing are going to be looking at that from the past couple of years who had interest rates high 7s, 8s.
Yeah.
And it could be a prime time potentially, but they just want to keep waiting to see, is the interest rate going to keep going lower?
Yeah.
When in reality, it could just be a good time.
Yeah,
but just evaluate that with your loan officer that you trust and just to see if it does make sense.
Yeah.
Well, one of the things I said to you two before we started this was I grew up in central Kansas, and in the last 75 years, the U.S. population's doubled. And so people aren't moving out to where I grew up. They're wanting to live in a place like Lawrence or Baldwin City or Eudora, or somewhere where there's lots to do and a great place to raise your kids and job availability. And so, you know, the fear is if you sit on the sidelines too long, you miss out on the opportunity.
Yep.
And so, and we talked about this too, right before this was, you might be able to speak to this, is the demographic of a first-time home buyer isn't what most people would probably think is 28 years old or something.
You bet. And it's a shocker, guys. It's a shocker. For the first time in history, the first-time home buyer is currently described as over 40 years old.
Yeah.
So 40 plus is your first, that's your national
average.
That is your national average of a first-time home buyer is 40 years or more. And that's first. That's first. And so, you know, why? Well, affordability, that probably is the biggest factor, affordability. And so, again, plant the tree today if you haven't already, because you just want to take advantage of that growth.
And also what I'll say, too, that most people don't realize is even if you have owned a home before, if you haven't owned a home in the past 3 years, then you're considered a first-time home buyer again.
Yes.
So that could also be playing into the numbers of the ages as well.
Yep.
But again, they would have had to not own a home in 3 years.
But and that rule applied 10 years ago.
Yeah.
So
the fact that it's up so high, I mean, it is.
If we're comparing apples to apples, so if that was the rule 10 years ago, and we're comparing first time to today compared to first time 10 years ago, it all was factored in then as well. So what we're seeing is just an increasing trend in how affordability is making it a little bit harder to get in when you're in that 25-year-old time frame, as opposed to what we might think of, as you said, Patrick, what you think of as the first-time home buyer.
And you could probably peel that shell back and even find all sorts of different things with societal changes, people looking at new career opportunities in their mid-20s versus buying. So all sorts of things I would think contribute to that.
Yeah. And first-time home buyers do make up most of the buying market still. And I mean, I don't necessarily see that changing. Do you, Rob?
No. Although, you know, there's churn that occurs in the marketplace, and we need that, because in order for first-time home buyers to have available, affordable housing, we need the folks that have been in a house for 7, 8, 9, 10 years, whatever it is. I've been in my house 30 years. Oh my gosh.
Time for you to move, Rob.
It is time for me to move. But we need that. We need the movement to happen in the market. And we need what is it? It used to be called right sizing. I don't know what it's called these days, but
or downsizing or upsizing,
because
or
it could be
other way.
It could be down. It could, it's you know, with COVID we saw a greater need for office space, right, and an environment where you could work from home, and we saw urban markets start to dwindle a little more in favor of more of a suburban market because of working from home opportunities, and some smaller communities seeing some growth as a result of that, and migration out of the really intense New York City urban environments and so on. So people just move and shift, and we need that, right? I mean, we need that naturally to occur, so that those properties become available to the next
generation,
generation, or the next person or family, whatever it is that has the need, and opens those opportunities up. So I guess I need to go home and talk to Jamie and talk about selling. So
making your house available for others, because it sounds to me like if you've had your house for 30 years, your mortgage is paid off.
I'm not doing my part. That's right.
And Lawrence, do you see, or where do we see the most activity as far as price ranging?
It's still in the meat. The meat of the market is going to be in that $2.25 to $350. I mean, that's where most people exist. That's where you're demographically, you know, and you're based on income levels and things. That's where most people find homes to be affordable. Problem is we just have such little inventory there. But still in units sold, still up to 350, and then it starts to dwindle back a little bit. But with the interest rates as good as they've been, people have more buying power, and so they can reach up. So with rates now dropping back down into the sixes, it increases your buying power based on that monthly obligation that you would have, and so they can reach a little bit higher.
Do you think that buyers should still brace for low supply looking into 2026, or do you think that'll lighten up a little bit more?
Well, so we have we've been operating at less than 2 months supply now for about 18 months, and prior to that, it was less than a year and a half supply. Our supply is slightly down compared to last year, but it's considerably up compared to 2 years ago. So we've had a small little dip back in the marketplace in 2025. I really think for our marketplace, it's going to maintain at about a 2-month supply for the coming year until we really do see some development starting with groundbreaking and streets in and just getting some additional inventory for upper tier markets even to move out of a neighborhood and into a new neighborhood, making some of the older homes available. I think it's just going to be a little bit yet before that happens. So I think most of 2026 is probably still going to vacillate right around that 2-month, 1.8 to 2-month supply.
Yeah.
Okay.
Wish I had better news, but I just hope it didn't go backwards.
So
Right?
if I'm a buyer or if I'm a seller, when might we anticipate that the spring market or the season starts up?
I hear from agents all different time frames. I see statistically the numbers really grow beginning kind of mid-March, around that spring break time. And so you start to see the closings fall into place more so in April, May, June, especially May, June, and then some July. So the most activity is going to happen probably mid-March, which means if you're going to consider getting your house on the market, really it's going to be the first of the year, right? It's going to be kind of, if at the latest, early February when you want to be ready and be on the market. But that's a qualifier, right? Because when that happens, you become part of this bigger influx of new listings that come on the market at the same time. There are more buyers, but there's more houses. And so they still have this incredible level of competition that exists in the marketplace. And that's what keeps our average days sold, or our median days sold, at 7 days on the market. Half sell for quicker than 7 days and half sell longer than 7 days, but a median of 7 days. So really, strategically, you might consider earlier because you'll face less competition and you might get some buyers coming out early out of the turn of the year and saying, okay, holidays are over, I'm ready now. And, if you get the house on the market even earlier than that peak, you might have less competition for other houses, but still be attracting more eyes from the buyers that are reentering the market.
Yeah.
Does that make sense?
Yes, it does.
I think it's all relative.
Yep.
We see very successful agents sell houses in November and December.
Right.
It's housing is a year-long. It's a year-long business.
Yeah.
And people list and sell, and buyers buy all year long. There just are some peaks that occur in that spring market that result in closings into the summer, and then it tails back off a little bit.
And for those people that are wanting to even enter in like the spring market or just whenever, it takes time to get your house ready to get on the market.
Yeah.
So if
and to
that's
ready
something
yourself as a buyer, right? To be
the steps. Yeah.
not only financially ready, but really emotionally ready. You've done the research. You've met with and had the opportunity to learn from a real estate professional who can help you understand expectations and what some of the strategies are, and
especially if you haven't purchased in a few years, because
you bet.
Things change quite frequently too.
Things not only change in the market as a whole, but they change in the price ranges. So, the strategy for a $400,000 house last year might be different than the strategy this year for a $400,000 house, because the market just ebbs and flows.
Yeah.
as we wrap this up, do you have any other bold predictions you want to throw out there, or anything that might be of interest to our listeners? I
don't think I have anything bold. I guess, and I'm not the one to predict, but I would say just stay tuned. We'll continue to communicate housing statistics on a monthly basis. We'll show you the trends as they're occurring and unfolding. You can follow those at lawrencerealtor.com. Just look for the link to market stats or market statistics, and you'll see the monthly reports that come out. I brought with me because I thought maybe I need to dig into these, but our monthly statistical report is for both Lawrence as well as Douglas County. We publish those online. They're 20 plus pages in each of them. They dig into everything about, the median ask price, the median sale price, the days on market, but also what's the listing activity look like, and how many houses have listed at what price range, and what's that competition look like. And so they're robust reports, and they're available to the public, and you can find those at lawrencerealtor.com.
Sweet.
Great reading right before bed.
Absolutely.
Are you saying to put you to sleep,
No,
Patrick?
just, something to relax with, a little something to help you deep dive as you dream.
Dream about housing, your next steps,
That's right.
That fireplace that you want in the corner.
Yeah, that's absolutely right.
Well, they're available online. They're in PDFs, and so they're great on a tablet, I guess, as you're floating off into your dreams.
Oh my gosh. Well, thank you, Rob, for joining us and going through all of this with us. And I do think we do have some good things looking forward to 2026.
Yeah, listen, I'm optimistic. I really am. I think
you're one of the most optimistic people I know.
Well, I don't know about that, but I feel good. I feel good about where this market's at. I mean, real quick wrap, because I know we're done. But we're up for the year.
Yeah.
Home sales are up, 6% for the year, right? So it's a nice, steady increase. We haven't seen tremendous increases in price, so that's helpful to our marketplace. It's a little more sustainable than these really ratchet, up levels that we've seen, 3, 4, and 5 years ago. And so it's much more manageable and steady. And so just to temper the expectations, don't look for anything huge or major, but I'm optimistic. I feel real good about where we're headed as a community over the next few years.
Yeah.
Me too.
Me 3.
Yay.
Okay, well, signing out.
Thanks for joining us on Lawrence Real and Local Keepin' It Real podcast. We appreciate our guests taking the time to join us. Don't forget to subscribe and leave a review if you enjoyed today's episode.
For more information, please visit us on the web at www.lawrencerealtor.com. And remember, whether you are buying, selling, or simply dreaming of buying your future home, we're here to help. Until next time, keep it real.
And happy house hunting.